When I was trading price action alone with no fundamentals, no institutional orders data, no knowledge of time cycle or currency calendar, I so much believed in demand and supply zones. Then came SMC with other blocks, which looked better, but it wasn't long before I realized that order block is just a renaming with little modification of demand and supply. No wonder some other blocks will work like it's really the truth, while some will feel like it's a liquidity pool. Does that mean these are not really other blocks, but just some marketers and forex educators coining words to entice unsuspecting customers? In this video, we will look into real order blocks. We will cover what they are, how to identify them, why some fail and some work, and finally we will talk about the institutional control block, which is the largest order block and most important one also. So I want you to sit back and relax, watch the video to the end, and learn as we take a deep dive into the world of order blocks. What are order blocks? Order blocks are price zones where big market players open huge positions. These huge positions lead to impulsive price moves, hence why demand and supply zones are order blocks. To identify an order block, you look for consolidation zones where price action is sideways for a period of time before making a strong bullish or bearish breakout. The consolidation zone is the area where smart money loads their positions, which eventually results in the impulsive breakout. So why then is the demand and supply zone not consistent, with some working perfectly and others failing woefully? This is because of two main reasons. The first one is that not all consolidation or sideways price actions are order blocks, even though price breaks out of the zone impulsively. When volume is low, price enters consolidation, and when volume returns into the market, we get a breakout. Marking this type of consolidation as order block is wrong. A consolidation that can be considered as an order block must happen with a decent volume behind it. This is because smart money participants are big players and they contribute most of the volume in the market. It is not possible for them to open big trades and volume will be low. So, consolidation zones with low volume will most likely fail. This can be seen in this example on the screen. Here we have a clear consolidation followed by a breakout, but the consolidation has very low volume, as you can see. So marking this as an order block resulted in a failure when price returned to that zone. Unlike in this second scenario where the consolidation zone has significant volume to it, you can see that when price returned to that zone, it reversed from it. The second reason why order blocks fail is because breakout direction doesn't tell the institutional order opened in the block. Smart money is divided into two categories. We have institutional traders and the dealers. These two are the major participants of the currency market, and their trades are always opposing. When dealers buy, the institutional traders sell, and when the institutional traders buy, the dealers sell. This can be verified by checking their net position from the Commitment of Traders report. On the screen right now is the net position of the dealers and the institutional traders. And as you can clearly see that they are exact mirror of themselves. When the dealers are buying, as you can see right here, the institutional traders were selling. And in this region where the dealers were selling, the institutional traders were buying. Of course, we know buying cannot happen without selling. So inside an order block, there are equal and opposite big orders of buy and sell. Price can break out in favor of any of the two players, although most times it goes in favor of the institutional traders. This is because the institutional traders are the smart money side trading for profit, but sometimes it breaks out in favor of the dealers who are trading just to edge. That is why they are referred to as edgers. When the breakout is in the direction of the institutional traders, the order block will hold price and most likely lead to reversal when tested. This is because the institutional traders are in it for profit, which will only be achieved if price continue trading in the direction of their initial position. To ensure this, when price returns to their entry zone, they load up more positions to defend their initial bias and also increase their accumulated positions, leading to reversal from the zone. However, if the breakout is in favor of the dealers, they are not making money on the move because they are edgers. Whatever they make on the winning trade, they lose the exact amount on the event they are edging against. In the same vein, when they lose money on their trade, they are not in loss because they make the exact amount in profit on the event they edge against. So when price comes back to the order block that breaks out in their favor, they don't really care. So they don't add more positions to defend that direction. So the order block fails. Another reason why such order block that breaks out in favor of the dealers will fail woefully is because the institutional traders that traded in that block are in loss on the breakout. When price heads back towards that order block, the institutional traders will load up more positions to make sure the order block fails and send their initial positions into profit. So the order block fails with ease. If you are getting value from this lesson, let me know in the comment section. Your comment is how I know I am not wasting my time making these videos, and the views I get are from real traders and not ghosts or bots. Don't forget to like the video also, and if you are not subscribed to the channel yet, hit the subscribe button and turn on your bell icon so that you get notified when we drop new videos, which I'm very sure will be helpful to you as a forex trader. Now that we know order blocks can break out in favor of either the institutional traders or the dealers, it is clear that retail traders will continue to have problems trading order blocks. The only way to solve this problem is to have access to the orders of the institutional traders. So you can confirm that the breakout is actually in favor of the institutional traders and that the order block will most likely hold and reverse price when retraced to. That institutional data is the advantage I and other members of our data channel and discussion Telegram group have over regular retail traders. The link to join that data channel is in the description of this video. In addition to knowing that an order block is institutional, you get to know if additional positions are added or not when price returns to the block. I have a full in-depth video on institutional orders where I explain the types and how to identify and trade them using institutional data. You can go ahead and watch that video after this one. I will leave a link to that video at the end of this one. Other than the demand and supply order blocks, there is another order block which plays a bigger role in market analysis on institutional level because it is the largest order block and we call it institutional control block. The control block is the most important order block. Both large investors and small investors use it. I will explain everything you need to know about the institutional control block in our next video. So like this video, hit the subscribe button and turn on your post notification so you'll be notified when that video drops. I'll see you guys on the next one. Have a great day.